And we've been talking about taxes and whether it is the credit and whether it is a new rule coming up and the ERC. We've been putting out knowledge related to taxes for everyday folks, right? So we talked about accounting method, we talked about tax structure, but today there is a popular tax terms that folks don't always understand the difference. So we decided to tackle that. There's only 3 items on the list that really, you hear that from time to time, but you may not make any clear distinguish between those concepts. For example, and one of the things is called tax exemptions, tax exempted. What does that mean? And then tax deduction. So whether that is different from tax credit. So these 3 concepts, exemption, deduction, and the credit, and how much do you know about them? Because these are important. Every time people talk about, oh, you're gonna have a tax benefit if you do this, and your immediate thought need to come through these terms. Are they tax credit, or they are tax deductions, or is that a tax exemption? So what's the difference? If someone says to you that there's a $5,000 tax exemption, a $5,000 tax deduction, or $5,000 tax credit, does that mean the same to you? So that's what we are going to go about sharing and understanding for today. So this is our topic for today. We focus on tax concepts, exemptions, credits, and deduction. I know I didn't put in the exemption, but exemption is so easy to understand. And I am going to focus on the credit and the deduction for you. Speaker information, me, Ying Sa. My name is Ying Sa. I am the CEO and managing partner at Community CPA. And the Community CPA is a full service company. And we are in Minnesota, Iowa, California, and we're looking at opening up more branches in the coming year. So just watch us, watch how Community CPA grows, and knowing that if you're our client, you share the same sentiment with us, because we actually grow with our clients. Grow all the webinars we present, videos we have on our YouTube channel, and we want you to know that there is no responsibility in terms of how you use it. And we do our best to make our webinar accurate, useful, and attractive to your brain so you can absorb the knowledge, but that doesn't mean everything is absolutely correct. And that, interpretation can change, law can change, a president can, can be voted out, and, things can be new. So they're just, tax world is never really a world that you can stop learning. If you declare yourself as a tax expert, and you also signed up for a lifetime learning, that's just how it is, right? So we do a lot of tax webinars here, because those are also one of the most useful life skills. And someone said that you can't escape 2 things in life. Number 1 is death. Number 2 is tax. So true, right? And the tax is absolutely part of your life. A lot of people view that negatively, but with me, I want you to view that positively, because that can help you to grow. All right, so concept of these 3 things: exemptions, deductions, and a credit. And just really quick, I want this to be in your brain. When people talk about exemptions, that basically says that the tax regulation and the IRS agreed to take your income down. Whatever the income you got, exempted, you don't need to pay taxes. And you heard of that, right? For example, you got a retirement fund, your Roth IRA, when they come back to you, the interest you made inside of Roth IRA is what? Income tax exempted, right? So tax exempt reduces your income, period. So if you're imagining a income statement, you have income, you have expense, you have profit, right? the profit you have, it will calculate the tax dollars. So these three concepts are related to that income statement. Exemption come off the top. So it's the income exempted, no taxes. But what about tax deduction? Tax deduction are your expenses. So what government says that these are tax deductions. You can deduct. So for example, and your standard mileage rate times your mileage, that's your tax deduction, right? So the government is giving you the rate every year. And now in 2022, they made it so hard. They give you two different rates in the year. So you calculate your mileage from January to June with one rate, from July to December with one rate, right? So this envisioning your income statement, that's right in the middle. That's your expense. So tax credit though, it is applied to your profit. In which way? Your profit times tax rate is your taxes, right? That tax dollars will be reduced by your tax credit. You see how these three concepts really come in to just knock off your income statement. So your income has exemption, your expense has tax deduction, and your profit times tax rate, and you have tax credit. If someone utilizes all of these in one income statement, they probably don't need to pay taxes at all, right? Now, let's look at the example I put together. I was really kind of running the last minute, but I put an example for you on the exemptions because I'm not going to spend a lot of time on exemption. So I want to give you a good example so you register with that exemption. To take your income out. Nonprofit organization is a good example. When you are nonprofit, remember when you set up a nonprofit, you have to go to Community CPA or you go to other law firms and you're like, I want to be a nonprofit. So what they do is they apply for exemption. They apply all of your income to be exempted so you don't pay taxes. So that is the nonprofit organization. We also call them exempted organization, right? So that is what that exempt, that word come from, is because the income is exempted from paying taxes. So related to individual, if you are an individual and you're married, you file 1040, and remember that standard deduction things. So that is exempt. Oh, that's called personal exemption, marriage jointly exemption. That is exemption. Why do they call that exemption? Because they just take the income out of you. If you made a W-2 income of $25,900 in the year as a couple, and you have that exemption come in, then your income is zero. Makes sense? So it is actually exempt that income from subject to taxes, income tax. So that's exemption. Travel expenses is a tax deduction, okay? That reduces your income. You have income, then you have deductions, you have expenses, so make your income less, so you come up with a number that is called profit. So that travel expenses is a good example of tax deduction, okay? And you may say that, well, of course I know that's a deduction. Why do you have to say it's tax deduction? Not all of your expenses is tax deduction. It has to be ordinary, reasonable for your business, right? So remember the IRS says that, you can't deduct this one, it's not reasonable. And you cannot deduct this one, it's not necessary. So IRS auditor has right to decide on what is reasonable and what is necessary. And you also have right to argue that, no, this is reasonable. No, this is, necessary. If you are just gonna buck head and nobody agree with each other, and the two of you, actually the auditor don't go with you, but you can go to appeals. And you can explain to appeals office to tell them your opinion. Then if appeals are to appeals to argue with you. So you take the document, you go to appeals to present your case. However, you cannot add more evidence in to the appeals, and you should work on what you give to the auditor. That's how auditor made that decision, right? So with that said, and let's go to tax credit. So tax credit, remember, that is out of your profit. If your profit is $100,000 and your tax rate is 21%, then obviously $21,000 taxes there you need to pay, right? But tax credit is a direct offset of your $21,000 tax. It is not related to the income, not related to tax deduction. It is just about your tax dollars. Do you have a tax bill to pay? You go, yes. And then your tax credit is how important that is for you to understand what is the tax credit, what is tax deduction, what is tax exemption, right? All right, so let's look at a couple slides I put together, which is give you some guidance on the deduction. Business expense are the cost of carrying on a trade or business. These expenses are usually deductible if the business operating and makes money, okay? At least you have an intention to make money. So I have taxpayers goes, you know, I have been losing money with my business. This is my 3rd year. Someone told me that I should just close the business and open up a new one. Otherwise, IRS would audit me. You know, IRS would audit people for different reasons. And if you have a business loss, but your documentation of the loss is proper, I would not even make that a reason to close the business, open up a new business. Because the longer you hold on to the business, the more goodwill you have, right? Imagine if CommunityCPA.com closes every year, opens next year, then who is going to remember CommunityCPA.com? It is because we are on the market for almost 30 years. That's why you remember it. That's why you heard it, right? So the goodwill of a business is important, and you create a legacy, and you want to have that to be in the same organization. So even if you lose money for the first 10 years and you didn't make it, you make it later. And there are people doing that. There are people working full-time job, but working on a business also, and they come through 10 years later, start making good money. It is not wrong to lose money. So with that said, when you have deductions, you have deductions. When you lose money, you lose money. So the money you lose should help you to reduce your tax liabilities in elsewhere. So this is where we care about being right, being accurate. We're not worried about how long you are going to lose money, because business takes time to establish. If everybody makes money in 3 years of starting business, then I think the whole world, everybody would start up a business. The reality is 95% of small businesses fails, percentage-wise, right? Just be proud of the successful small business owner. I am so proud of you. I have you. I have a lot of you here, and I know how hard you work. So I know it is not easy. I know it is not 3 years going to cover it. So with that said, you just want to make sure that you have a good record, and that you save your supporting document. And as long as ordinary and necessary to your business, yeah, we document that. And we're not sensitive to whether you are losing money or making money in terms of saving expenses for deduction. It is important to separate business expense from the following expense, okay? The expense used to figure out, the expenses used to figure the cost of goods sold, because those are inventory related. So when you are doing expenses don't belong to immediate deduction. They need time. For example, machineries. For example, inventory. So when you're trying to figure out the cost of goods sold, because they are expense, right? When you're trying to figure out the cost of goods sold, you need to take care of your inventory on your balance sheet. So basically, as a regular business, you buy supplies, you put on inventory on balance sheet. They're not your expense yet until you sell it. So that's why we're saying that you want to really separating the business expense from cost of goods sold to others, from inventory to other business deduction, and then making a clear roadmap on how you purchased it, how you used it, and how you sold it, right? Capital expense is on your balance sheet as well. If you bought a $500,000 machine, and unless you apply special tax rules, they should be depreciated by the year of the machine's life, right? 15 years, 7 years, and you can look up IRS guidance to know what years you should apply. But recently, like if you bought in 2023, you can still use bonus depreciation, which will help you to run 80% of your $500,000 into expense. So that is the capital expense. Of course, personal expense, right? Personal expense is not business expense. And you may say that, well, you know, I'm so busy and everything in business is me. So I don't think it is necessary to separate my personal expense. But that's not IRS's position. IRS do want to make sure that if you are a restaurant, and maybe you shouldn't be having all these baby formulas and the baby diapers charged into your restaurant, right? You may argue that 1 or 2 diapers are made for the bathroom in the restaurant, but it should not really have a lot of baby supply just because you just give birth to a new baby. You got a lot of expenses and you just run it out of your business. So personal expense, if you have a good habit of separating your personal expense and the company expense, and I'll tell you, you will run a better business. I'm not even gonna say that, oh, this is good for you when you get audited. You know, how often do people get audited? Not very often. But to run a business, to really know whether your business is doing good or bad, or maybe okay, and you really do have to have a clear accounting. And do not put your personal expense in your business. If your personal expense is a lot, maybe it is time to say that, can you try to save some money on your personal side? Why are you spending money like that? We do have business owners spending money senselessly. Why? And why are you still spending so much on the personal? Do you really use that? Do you really need to do that? If not, save that money. You can reinvest that into your business, right? So it is a lifestyle we are preaching. We are not trying to, just tell you that let's figure out a way to fight IRS. Of course, if you have a clean book, if your accounting is superb, I'm not worried about IRS audit. It will be a good meeting with the auditors, showing auditors how we run business. It is a safe place, right? The auditor is not going to go around to compete with you or to tell other people how you do business. And it is just a really, if the auditor has a lot of experience, it's actually sometimes would give you business advice as well, saying that this could be done this way. It's better for IRS, is also better for you. So those are just knowledge exchange. And when you really are doing your accounting right. And what are the business tax credits? So now we covered about tax deductions, right? And you understand the deduction, to separate your personal from business. So what are the tax credit? I want to introduce couple tax credit and also concept of tax credit, because it's a little bit confusing when we talk about tax credit. So hear me out. Business tax credit are an amount that companies can subtract from taxes owed to the government. Okay, so business tax credit are applied against taxes owed. So you may say that, oh, What if I don't owe any taxes? Great question. Let me answer that to you in the next slide, but let's look at this. Businesses apply tax credit when they file their annual or quarterly tax returns. Annual tax returns could be what? The income tax returns, right? So what is quarterly tax returns? That could be payroll 941, am I right? Right? In United States, the IRS oversees the application of business tax credit, as the credit are used to offset a company's financial obligation to a federal government. So in here, IRS oversees tax credit that's given by federal government. But on the other token, the state revenue agency oversees the tax credit that's given by the state. Yes. So, the way I look at the state, I am actually from Canada. So the Canadians has a lot of business with Australians and Europe. And then, after I moved to US and I started Community CPA. So in this process, what I start to realize, so in my own way to understand the state, and I see them as a separate little country, just like Canada and US and Mexico, or, just like Australia, Canada, and the US. So I see each state as their own little country. So the federal government impose a whole bunch of rules. The state will decide, do we take it? Or we take it, we don't take it, or we take half, we take 1/3. So the state has the right to agree with the same way doing it or have alternative way of doing it. So every state, based on their own situation, the governor and their cabinet will be working on credits and the incentives that helps the state to grow, right? So, just like in Iowa, the state is making moves to exempt some of the income tax. That has been a long time coming because Iowa has income tax. Iowa also has very expensive property tax. Iowa also has sales tax. Any tax you name it, Iowa has it. So Iowa, of course, on the revenue side for the state is always doing good. Iowa don't really, I live in Iowa for, how many years? Maybe 20, 27 years. So Iowa didn't have a deficit. There may be just one terms of governor had a deficit, then the rest of the governor didn't have deficit. And I, as a tax person, I see that coming from a lot of those collections. But Iowa the government is moving towards to, letting go of some of those revenues. So giving some credit, giving some exemptions, giving, deductions, probably nothing really new, but on the exemption and tax credit side, it is working and the government is working on that. So as a little, if you view that as a separate, powerhouse, and they will do things, look at what federal government did, then they will do things accordingly. And in generally speaking, Iowa's legislature are really try to be on the same footings with the IRS. So when IRS propose a new credit exemptions, then Iowa accepting it. But some of the states like California are very innovative and they never really accepting exactly as it is. They always do some twisting and good or bad, I don't know, but I just, from my end, I just know that it's a different work for CPA firms. So with that said, I want you to understand the power within the state. So they may not, you can get your federal taxes exempted and all that, but it has nothing to do with the state, right? All right, so let's look at the business tax credit versus business deduction, right? So we covered deduction. You kind of understand that deduction just expenses coming in. but credit are the one that offsetting your credit. So I have an illustration here with 5,000 tax credit versus 5,000 deduction example. So let's go through this example. So say a business had a $5,000 tax deduction and will save a percentage of that 5,000, right? Let's say the business paying 21% taxes, then 21% taxes, it will be the $5,000 right here. We have $5,000 tax deduction, and it reduces the income. So the profit lowered by 5,000. And if I use 5,000 times 21%, so my real tax saving is $1,050, right? So in here, my example is 20% of tax bracket. So it's 1,000 in terms of tax deduction. But if the corporation qualifies for 5,000 tax credit, so however, they benefit from the full 5,000 deduction. So let's say the company has a $5,000 tax liability. They're about to write a check to IRS to pay 5,000, but they got a tax credit for 5,000. So what happened? They pay zero, right? So this is where we're talking about the difference between the deduction and the tax credit. But within tax credit, there's a very important concept to understand. So whether the tax credit is a refundable tax credit or it is a non-refundable tax credit. So by the meaning of the word refundable, so the refundable just means that regardless and you have tax liability or not, you're gonna get the dollar. The $5,000 gonna be yours, even if you didn't have tax liability. That's refundable. So help you to think, what are the refundable tax credit? Earned income tax credit, like the low income tax credit the people get on the 1040, that's refundable because the people didn't pay taxes. All right, so that's refundable. Non-refundable tax credit just means that you may get the tax credit, but it is not gonna be yours as a refund. It is only going to offset your taxes. Then you may immediately go, no, Ying, then what if this year I got $5,000 tax credit and I just not gonna be able to offset anything because I had a loss. So what can happen to my credit? Your credit will be in your carry forward value. What I mean by that is when you do your taxes, it will still be reported to the government that you have a credit, but it's non-refundable, so you don't get it, but you will get it in the future when you finally have to pay taxes. That 5,000 will come into play, all right? And you ask me, well, how long this thing gonna go? It's gonna go for 20 years, unless it has been told differently. Okay, so you have it for a long while. This is one of the things I want to mention to our taxpayer. You know how you shouldn't be switching your tax preparers left and right every year. The reason is when you switch, if your new taxpayer doesn't know to look at your carry values from your last return, you could lose that without you even realize. So often that happens, and we would get clients and with their last year's return, because they didn't like the tax preparer, so they left them in 1 year. But this tax preparer did not carry all the necessary numbers from the year before. So when we look at the tax return goes, where is your carry over losses? You said that you had, and it's not on the tax return because it wasn't carried over. So no wonder they want to change, but they really had suffered from inaccurate reporting on the tax return because those things were not carried over. And your tax credit could be totally lost. And you don't even know why, just because you are changing preparers and your new preparer is less experienced and I didn't really have that knowledge to search for these kind of things. So in our firm, when we get a new tax coming in, and we are very sensitive to carrying value because it's a huge value. Some people, the largest one I saw was over $500,000 on passive losses. If people don't carry that for them continuously, one day they're gonna make a lot of money on the stock market. They're gonna lose all the chance to save the capital gain, right? So those are the things. I just want you to know that there's some of the numbers are sitting in the background. You don't see it, you don't benefit from it, like the non-refundable tax credit, but it's so precious. It's like your deposit. You need to carry it on to next year. Make sure your tax preparer carries it on next year. But if you're doing taxes with Community CPA for years and years, it carried automatically in our system. So same thing with other tax preparers. It should automatically carried to the next year. So as long as you stay with the one tax preparer, that carry forward shouldn't be an issue unless they're just not doing it right, right? I say that because I have seen people claiming to be tax preparer really don't have the knowledge. And very sad to see tax folks and taxpayers and ended up paying more taxes, so much more than what should really be done correctly. If you're one of those people, I mean, you're not alone. There's a lot of people in that boat. So, you know, I just know that President Trump for sure did not overpay taxes, but everybody else, I have a question mark. All right. The next slide is about tax credits. So I want to kind of walk you through, name a couple of those tax credits for you. And, you know, so you know, especially if you are a business owner and you don't want to forget, these are the most popular tax credit that you are getting, okay? So make sure you know these names for that. And then you ask your tax preparer, hey, did you do this credit for me? Did you do that credit for me? So those are important, right? We can never really take care of every one of you out there, but we can give you the right question to ask so you can get cared by other professionals. All right, so the first one I want to talk to you about is the healthcare tax credit. You may qualify for a small business healthcare tax credit that could be worth up to 50% of the cost you pay for your employees' premium. Okay, so if you're a nonprofit, it's 35%. 50% of the cost you pay for your employees' premium, right? Enrolling in small business health option program, we call them SHOP plan, is generally the only way for small business or nonprofit to claim this tax credit, okay? So the conditions as following. You have fewer than 25 full-time equivalent employee. Full-time equivalent just means that you maybe have 4 part-time people becoming 1 full-time employee, right? Because they all work 1/4 of the hours. And your average employee salary is about 50,000 per year or less. So, you know, average just means that some people are over 50,000, that's okay. But if you got 10 people there, and you average them out, they're below 50, then you qualify. If it is above 50, you don't. And you pay at least 50% of their premium cost. So if the premium total is, you know, it's 100,000, you pay 50%. So you at least pay 50,000 on your cost. And you also offer SHOP coverage to all of your full-time employees, right? So example right here, I give you a calculation. So you have a number of employee of 10, your wages total is 25,000 total. So if I divided that by 10, it's 25,000. So I'm below 50, right? So let's say you pay of the premium, and that premium is 70,000. Then your tax credit is 35,000. Stop right here, folks. That 1,000 is not tax deduction. That 35,000 is it. Okay? That means you pay $35,000 taxes, you're not paying. And this one, it is a tax credit that you can claim it. So this will offset all your tax liabilities and it become a refund for you. Make sense? Right? This is tax credit, folks. It's not tax deduction. That's why we are here naming several tax credits. Here, R&D. R&D is called Increased Research Activity Credit. This credit is generally allowed for expenses paid or incurred for qualified research. Qualified research means the research expenses that are research and experimental in nature and are not capitalized, means that it's not on the balance sheet. This research must be undertaken for discovering information that is technical in nature. Its application must be intended for use in developing new or improved business component of the business. So a lot of drug companies have R&D. A lot of software companies have R&D. Tesla has R&D, okay? And if you are in certain business, I'm just trying to think of our small business, and you can have R&D. And when you're doing research, look at this example. This is a simple example for R&D, and you are actually getting a tax credit, okay? And here on the next slides, so let's look at this example. 100,000 on supplies, 100,000 on payroll, and the 6% of 200,000 is 12,000, that's a credit. And I know the R&D credit has been updated by the Inflation Act. And I noticed that my example here, this one, it is not the updated example, but the calculation is similar. So I do have another webinar that talked about R&D updated tax credit calculation. Then you should be watching that video. You see how knowledge do update. And when we put together our slides, we know these are important tax credit, but this particular example section, it wasn't updated for the new calculation. And here, R&D credit note, the research credit generally isn't allowed for the following type of activity. We put this together because we have a lot of questions coming from folks and saying that, oh, do you think this is R&D? And our firm actually provide service for the eligibility study. So when you have a business, you felt like you can qualify for R&D tax credit, but you're not sure whether you're eligible or not, you have questions and you want to consult, and we provide that service to you. We do eligibility study for you based on your situation. Then we will give your guidance to your accounting department and show your accounting department how to collect R&D expenses. Once we got those, that's when you file taxes, those expenses you should be giving to your tax preparer and the tax people. They will know how to calculate your R&D. So 3 steps, right? Eligibility study and accounting guidance, so you know how to do accounting, and then you supply that to the tax team, then they can do the tax calculation for you. And we, at our firm, we do the credit eligibility study for you whenever you have a question related to credit. For example, the R&D credit, for example, the health insurance premium credit, and then the other credit is also well known, but really not widely used by the small business folks, and which we really think you should, is a work opportunity tax credit, folks. work opportunity credit, it means that, you know, percentage of the salary that you hire that person, government gonna turn that salary to pay, to turn that into tax credit, and it's refunded. That means that you get the money, even though you don't have tax liability. So 25% of the wages you paid to those people, and you can get that refund back as a tax credit. All right. So let me give you examples of what they are. So, you know, you see those needy family, if you get welfare, if you hire someone so they come out of welfare, they qualify. And if it is a rehabilitation referral, you qualify. Ex-felon qualify, and you qualified veterans, of course. I mean, you know, in our firm, we actually have 2 veterans in our team. And so, you know, these are the people, they bring employer tax credit just because they're part of, you hired them, right? And then you have the summer youth employee program, which says that if they are at least 16 years old, but under 18, okay, and they are employed between May 1st, come on, it's already started, to September 15, and 25% of the wage paid to the qualified person. And it says that a non-refundable, 10,000 wages, this is the wages amount, gross wages, times 25%. So that gives you 2,500 tax credit. And this one, this tax credit, here it says non-refundable. That means that you must have the tax liabilities of 2,500 in order to offset that 2,500, okay? So this is equal to 10,000 refunded, rate at 25%. So basically, I guess what I'm trying to say in the example here is that, you know, when you pay, let's say you pay a rehabilitation referral, referred a person as a on salary. Say the month you paid $5,000. So the $5,000 times 25%, so that would give you $1,250. And that dollar amount is your tax credit. So let's say you need to pay $1,250 taxes this year, but because of this credit application, it will just wipe out. Then your tax liability is 0, right? Now, the next one I want to briefly talk about is this employee retention credit, ERC. This is also tax credit, but it is not crediting your income tax, it's crediting your payroll tax. So remember earlier when we defining tax credit, we're saying that annually or quarterly. This is quarterly, okay? And the ERC is for quarterly. I'm not gonna dive into details for ERC, but you just know that the ERC credit is refundable credit, which means you get a refund check. You get a real check. However, don't forget to file taxes for the real check you received as income, okay? So if your real check refund is in 2020, you need to amend 2020. You need to add the tax credit to your income. So you would apply tax rate to it. So you do owe income tax on that, even though it is refundable tax credit for payroll tax. The next one is also popular one. It is the tips for the restaurant. That credit is for employer tax paid on tips, okay? So This one is refundable, which means that it's refunding you via your income tax return, okay? So basically, what does is, you know how your employee reported tips and you have to match Social Security, Medicare, and that match you did in your business is being refunded back to you. If you are a S corporation business owner, it goes to your 1040. And if you are a C Corp, it just stays in the C Corp, right? So that is another credit. So basically, and throughout this webinar, I kind of told you about several popular, widely used credit: health insurance premium credit, R&D credit, and the work opportunity credit, the ERC credit, and tips credit. Those are tax credit, folks. And that really brings me back to the conclusion of our webinar today. And we want you to understand the concept between tax exemption and tax deduction, tax credit. Exemption is what? Taking out of income on the top of the house, right? And if you're imagining an income statement, that is taking out of your income on the top. Tax deduction is something in the middle. It's deducting your expenses. It's like your expense and reducing your income, basically, right? As a part of your operation, tax deduction. And on the profit side, the tax credit related to that, because your profit times tax rate, whatever tax liability you come up with, your tax credit will offset that. Of course, not all the tax credit is offsetting your income tax liability, and ERC, it is a tax credit that offset your payroll liability. But it is not right now. The ERC is going in to reduce your payroll liability and give you a refund check. So ERC is refundable, okay? And the tips credit is also refundable, folks. So you see, when we talk about tax credit, we're kind of dealing with refundable, non-refundable. If it is non-refundable, it is so important for you to know that you have it there. One day, one of these days, you're gonna use it. So this is where when people do tax planning, and we can plan your taxes in such a optimal way that you're gonna use up your credit. Why are you sitting on the credit? That's almost like deposit, not making interest expenses and just watching your deposit. What's so good about that, right? And with this high inflation we have today, and we want to make sure that you use your credit, you use your carryover value as soon as possible. With that said, and to reach us, you can email Catherine at communitycpa.com, and that's our phone number, 515-288-3188. We open Monday to Saturday. Do you know that? Do you know we are the only CPA firm in this country open on Saturdays? Because we are catered to our small, successful, hardworking small business owners. We know you work on Saturdays, so that's why we are here. And I like to see you again on Tuesday, Saturday, and giving you what I know and whatever I know, we share. We don't need to hold on to our knowledge, and we want our community, just like our name suggests, all of you to know what we know so we can all be better. And we, Community CPA, we do better when our clients are all doing better. Thank you very much. We'll talk to you again.